Sam, I hear all this talk about owning index funds. I hear about QQQ and SPY. They both seem to be really popular. So which one should I be using? This is a great question. Let's go over the differences between these two, and at the end, I'll share which one I use in client portfolios. SPY is an index fund managed by State Street Global Advisors, one of the largest investment managers in the world. This fund tracks the performance of the S&P 500 index, which is made up of the 500 largest companies in the US, weighted by how big they are, otherwise known as their market capitalization. The index includes companies from many different industries, including tech, healthcare, finance, and utilities. QQQ, on the other hand, is technically what the financial industry calls a unit investment trust. It is managed by a company called Invesco, and it essentially acts like an ETF index fund. It tracks a different index, though, than the S&P 500. It tracks the NASDAQ 100, which is made up of the 100 largest non-financial companies in the world, mostly tech companies. Let's look at holdings. SPY's top 10 holdings looks like the following. You can see Apple, Nvidia, Microsoft all at the top, and the top 10 holdings make up 37.22% of the entire fund. QQQ's top 10 holdings looks like this. You can see Apple, Nvidia, and Microsoft are also in the top 10. However, they make up a much larger holding in QQQ, and QQQ's top 10 holdings make up almost 50% of the entire fund. Let's get down to brass tacks. How have they performed? Over the last year, SPY has outperformed QQQ by about 1.7%. It's not really a big difference. However, over the last 5 years, QQQ has had over a 44% higher return. And over the last 10 years, the difference is even more staggering. QQQ has outperformed SPY by almost 200%. Okay, so which one should you choose? Well, it's hard to ignore QQQ's outperformance of SPY. Over the last few decades, it's been one of the best performing assets available to everyday investors. However, as the saying goes, past performance is not always indicative of future results. SPY is more diversified. Its holdings, top 10 holdings, make up a smaller percentage of the overall fund, making it less risky. And the industries in which it represents is much more broad than just tech in the NASDAQ 100. So bottom line, I would include both of these funds in most aggressive portfolios out there. Of course, for your individual circumstances, you should get the advice of an expert to see if you may have other things that lead you to need other forms of investments. For all of my clients, I do include more funds than just these two in their portfolios, but these two are a staple and a core piece of any good investment portfolio.